Assalamualaikum warahmatullah. Welcome back to Sada Education. I would like to summarize or recapitulate what I have been doing for the past 24 videos that we did for the Sada program. And I think, as you know, that we are here to promote financial literacy and also to highlight the importance of consumer financial protection, and therefore the preliminary effort by SADA is to give an overview of the Islamic finance concepts and principle. It may be a bit academic for the layman and for the netizens, but I will try to provide a simple illustration as we move on to understand the issues in the Islamic banking sector. As you know that the Islamic bank is the middleman that channel the funds from the surplus sector to the deficit sector. So we are looking at the mobilization of deposit fund to the sector that need this fund to finance their consumption and investment, and therefore the understanding of a deposit product, whether these are saving account or current account, fixed deposit or investment account, can further be discussed as we move on into our program. At the same time, the financing arrangement is a very important component in Islamic banking, because most of us, indirectly or indirectly are involved in the participation in the banking scenario as a consumer. And therefore, the various product offering, such as home financing and vehicle financing, personal financing, overdraft, trade finance, and so on, can be further presented in our program so as to enlighten the listener about the dynamicity of Islamic banking. But as I have also explained, that the Islamic bank is established within a dual banking system, and therefore the challenges and issues faced by the Islamic bank are enormous, and therefore the performance of Islamic bank that we expect to see based on the Islamic labeling they are carrying must be presented accordingly to the claim made by the Islamic banking sector that all the products offering are compliant to Shariah rule, and we have the Shariah governance framework that monitors and that governs the Islamic banking operation, to ensure that the operation are within the ambit of Shariah values. And at the same time, we have the authority, the monetary authority, which is the central bank, that supervise and monitors the running of the Islamic banking business. But at the same time, we know that the performance of the Islamic bank is based on either the efficiency and business strategy pursued by each respective bank, and at the same time the bank performance is influenced by the economy. So during an economic downturn, banks will not be doing well, because in an economic slowdown, business are slow, and therefore the loan expansion or loan contraction is the case during an economic slowdown, and bank will not be able to perform as well when they are under prosperity. So during economic boom, we can see that bank can make more loans and financing, and therefore able to generate revenues, and therefore the earning will reflect a higher return on equity, and so this will be a good time for the Islamic banking business. For investors will be very happy to see their share value to go up during the economic upturn, but during an economic recession, we will see that all banks, including Islamic, will be facing a lot of difficulties due to the fact that during a slowdown, many of the loan and financing may default, and bank can see their earning declining, and their share prices to go down as well. Right. So this is the challenges faced by the Islamic bank within that was established within a dual banking system, and I have highlighted the fact that the Islamic bank would not be able to be effectively applying some of the traditional contract like mudarabah and musyarakah, or like istisna and salam, or even the murabahah or the murabahah by purchase order, or operating lease, that require the bank to observe an enormous amount of risk if they were to take on the object finance under the pretext of murabahah by purchase order, operating lease, of course, mudarabah and musyarakah, because these are contracts that are highly risky in nature, because the contract does not guarantee any form of profit like what we see in conventional loan, simply because the funding side of the business, which is deposit, are not able to sustain any form of losses in the project or in the sale, because by nature deposit fund are risk-free fund. No matter what, depositors have been guaranteed their full principal redemption plus the fixed interest income, and therefore the risk in deposit is no longer carried by the depositors, but they are now carried by the bank. And when the bank uses the deposit fund to make loan or financing, the risk in the loan and financing will be carried by the bank. And this is where we see the reshifting taking place from depositors to the bank. And when the bank is facing the risk of default, the regulator requires the bank to hold some form of assurance that if these losses from default occur, the bank have enough fund to absorb the losses, and this will come from the banking capital. So banking capital is an important ingredient in banking because this capital will support any potential losses arising from default. And if the bank is to do like murabahah by purchase order, if they were to do mudarabah funded by deposit fund, these are exposure that are highly risky. And if the bank wishes to do it, then they will have to support this risky exposure with more and more capital, and that doesn't seem to be viable today because banks, many Islamic banks are small and not heavily capitalized, and therefore they would only be able to do ordinary financing, which is collateralized or non-collateralized, and these are those provided by products such as tawarruk and murabaha. And finally, we will see that the credit risk faced by the bank is actually shifted to the borrowing customer by way of the credit spread that is charged into the loan rate. So when we pay our loan or our murabaha at a rate of 10%, for example, annum, for example, one component of the loan rate or profit rate is the spread, which is the default risk of the exposure that will actually, imputed into the loan rate, and therefore indirectly the borrowing customer is the party that is now absorbing the risk of default through their loan payment. So their loan payment will contain the profit margin or interest margin, which include the charges on the risk of default. So at the end of the day, the risk shifting is now conducted towards the borrowing customer. So risk shifting behavior, whether we are looking at Islamic or conventional, these are the prevailing practice. Risk are shifted from the depositors to the bank, and the bank shifting the risk to the borrowing customer. And this has been the conventional wisdom. And Islamic bank themselves are running the business based on the risk shifting model. To what extent the risk shifting model are acceptable, or to what extent it has been discussed, then this is how we should be looking at how can we move forward to ensure that some form of risk sharing can also be emulated in Islamic banking. The move from risk shifting to risk taking and risk sharing. So this is basically what we would like to see moving forward, how Islamic bank can actually evidence the true label that they are carrying, which is Islamic, and therefore the concept of risk taking and risk sharing that prevail in sale or al-bay should be highlighted and championed in the Islamic banking business to see that they are actually reflecting the true label of Islam that they generally carry in their business undertaking. Okay, thank you very much. I will further discuss this issue as we move along. Don't forget to comment and to share and to subscribe. Thank you. Assalamualaikum warahmatullahi.